back in our private equity days, the ultimate information edge had this, it had a very specific, unforgettable smell to it.
Oh, absolutely. Stale coffee, overheated printer toner.
Yes, exactly.
Yeah.
And just pure, unfiltered anxiety.
You're talking about the physical data room, right?
Yeah, the physical data room.
Before everything went to, secure cloud servers and all that, if you wanted the alpha on a merger back then, you were the junior associate locked in some windowless room on a Sunday at like 3:00 a.m.
Just reading through thousands of pages of unredacted financial documents.
Bleary-eyed.
Right. And hoping you didn't miss a single misplaced decimal.
Right, because that was the absolute perimeter of the information edge. It was physical, it was tangible, and honestly, completely understood by everyone playing the game.
Oh, for sure. The rules were clear.
You cross that perimeter, you trade on that material, non-public information, you go to federal prison. The rules of engagement were carved in stone.
They were. But consider what happens when that data room isn't a conference room in Midtown Manhattan.
Right. What happens when the data room is like a highly classified military bunker in a foreign theater of operations?
Yeah, that's a slightly different vibe than Midtown.
Just a bit.
Well, welcome to another session of the Insider Signal podcast. Our job here is always to track how the gravity of the market shifts because information asymmetries exist and people will always trade on them. You just have to accept it and track it.
Yeah. And we are tracking a massive tectonic shift today. We're really getting into the weeds on a huge regulatory enforcement wave that effectively rewrote the rules of the market in early 2026.
And to do that, we're pulling from a pretty heavy stack of sources today. We are looking at recent commodity futures, trading commission advisories, federal court filings.
Lots of court filings.
So many. Plus Department of Justice indictments and our own insider signal coverage.
Right.
The mission today is researching in detail how prediction markets, so platforms like Polymarket and Kalshi have just exploded. They allow you to bet real money on real-world events.
Which is fascinating. But before we unpack the mechanics of these specific trades, which, involve political campaigns and international military operations, we need to be very clear with you, the listener.
Yes, absolutely.
We are not endorsing or taking sides on any of the political or military events we're about to discuss.
No, not at all.
We're strictly here to impartially break down the legal and the financial facts contained in these source documents.
Exactly. Just following the money and the rules.
Mm-hmm.
Because for the young finance professionals and traders listening right now, the people who already know how to track insider flows on a traditional equity, the mechanics of what we are discussing today are critical.
They really are. The perimeter of what authorities consider material non-public information, or MNPI,
Right.
just aggressively expanded.
Right.
It moved from the stock market right into the world of event contracts.
So let's start with the catalyst. To understand the new rules, we have to look at the trade that basically forced the regulators' hands in the first place.
Oh, this trade is wild.
It really is. We need to talk about the capture of Venezuelan leader Nicolas Maduro, which was known as Operation Absolute Resolve, and a trader named Master Sergeant Gannon Ken Van Dyke.
Right. So Van Dyke is an active-duty U.S. Army Special Forces soldier.
Okay.
And according to the federal indictments, in late December 2025, he opened an account on Polymarket.
And for anyone somehow unfamiliar with the underlying architecture there, Polymarket is an offshore prediction market built on blockchain technology.
Right.
You basically buy yes or no shares on whether a specific real-world event will happen by a specific date.
Exactly. So over the course of about a week, Van Dyke places 13 distinct trades.
13.
Yeah, 13. He stakes just over $33,000 on contracts predicting the capture of Maduro.
Wow.
And we are talking about buying shares on highly specific contracts. Things titled like U.S. forces in Venezuela by January 31st and Maduro out by January 31st.
The trade sequencing there is really what reveals the methodology, right? Because he started small.
He did. He was buying sub $100 yes shares at first.
Probably just to test the platform's liquidity and, execution pipes, just making sure the money actually moves.
Right, feeling it out.
Yeah.
But then on January 2nd, which is literally the eve of the military raid, he drops more than $26,000 in concentrated bets.
Just a massive escalation.
Huge. And in the pre-dawn hours of January 3rd, U.S. forces capture Maduro.
And by the end of the day, Van Dyke's contracts resolve at $1 each.
Yep, netting him approximately $409,000 in pure profit.
Unbelievable. He had operational knowledge of the timing, The court filings explicitly note he signed non-disclosure agreements and actively helped plan and execute the mission.
He was in the room.
Literally in the data room.
Mm.
The broader market was guessing at geopolitical probabilities.
Right.
Well, he was quite literally reading the script.
Exactly.
But let me push back on the legal theory here for a second, because our listeners live and breathe traditional equities. They trade stocks, options, derivatives. An event contract is a binary yes or no bet on a geopolitical outcome.
Right. It's not a security.
Exactly. It does not represent ownership in a company.
Yeah.
So how exactly are the authorities stretching traditional insider trading rules to cover a digital military bet?
Well, the mechanism the authorities are using is actually brilliant.
Okay.
The U.S. Attorney for the Southern District of New York and the CFTC, the Commodity Futures Trading Commission, brought parallel charges.
Wait, so they're completely bypassing the Securities and Exchange Commission?
Completely bypassing the SEC. Instead, they are anchoring this on commodities fraud and wire fraud statutes.
Interesting.
And the structural linchpin of their argument relies on something called the Eddie Murphy rule.
Oh, I love this part. Which traces back to the 1983 movie Trading Places, right?
Dude, it does. Literally named after the movie.
That's amazing.
Yeah, in that film, for anyone who hasn't seen it, the characters execute a scheme using stolen, non-public Department of Agriculture crop reports to corner the frozen concentrated orange juice futures market.
Right. Classic.
It's a classic. But in the real world, Congress eventually formalized this through a provision in the 2010 Dodd-Frank Act,
Okay.
officially amending the Commodity Exchange Act.
Hmm.
The rule was specifically designed to prevent government employees from trading on non-public, government-generated information that could affect commodity prices.
Okay, I see the historical precedent, but help me bridge the gap here. Orange juice is a physical commodity.
Right.
How does the CFTC classify a yes or no digital contract about a military raid as a commodity under that 1980s framework? It seems like a stretch.
It sounds like it, but under the Commodity Exchange Act, the definition of a commodity is incredibly broad.
Broad how?
It includes not just physical goods like wheat or gold, but all services, rights, and interests in which contracts for future delivery are presently or in the future dealt in.
Oh, wow.
Yeah, so by trading an event contract, which is technically a binary derivative swap, you are trading a commodity interest. The CFTC is establishing that if you misappropriate confidential government intelligence, like military plans in this case,
Right.
and you use interstate internet wires to trade an event contract based on that intelligence, you are committing wire fraud and commodities fraud.
Because you're using a telecommunications network to execute a fraudulent scheme.
Exactly.
You're extracting money from a counterparty who doesn't have the classified information you stole.
That's the fraud.
I mean, trading on Polymarket with classified military intel is essentially like trying to rob a bank while live streaming from your own IP address.
Pretty much.
Because the blockchain ensures every single dollar is mathematically tied to your timestamp.
And that digital paper trail is exactly what the regulators used to build the timeline. Van Dyke didn't just get caught.
No.
He traded into a trap that was actively being constructed around him.
Right, because the speed of the regulatory rollout is staggering when you look at the dates.
It's incredibly fast.
On February 25, 2026, the CFTC issues a formal enforcement advisory. They explicitly state that trading event contracts on misappropriated MMPI violates the Commodity Exchange Act.
Yeah, they put the warning out there. Then, on March 12, they drop an advance notice of proposed rulemaking.
Just a couple weeks later.
Exactly. And this document is entirely focused on clarifying the federal oversight of prediction markets.
Right.
It strictly defines how inside information must be regulated within these specific platforms.
And that was followed by March 31. CFTC Director of Enforcement David Miller stands up at NYU Law School and delivers a speech outlining his top enforcement priorities.
And what's number one?
He puts insider trading and prediction markets right at number one.
Unbelievable.
He actively attacks the prevailing industry sentiment that insider trading laws don't apply to these platforms. He actually calls that view a myth and states it is flatly wrong.
He did not mince words.
No, he didn't.
Yeah.
And then, just 23 days after he steps off that podium, the Van Dyke indictment is unsealed. I have to say, you always did love a man who executes a perfectly timed regulatory clampdown.
Oh, I mean, competence is attractive.
Yeah.
What can I say? The architectural precision of how they laid the legal groundwork before dropping the hammer is genuinely impressive.
It really is.
Think about it. equity markets took nearly a century to build their enforcement infrastructure following the 1929 crash.
True.
Crypto took the better part of a decade to see meaningful federal action. Prediction markets, they ran the entire regulatory arc from an unregulated Wild West to federal indictments in exactly 60 days.
60 days. That's just wild. So the federal government is using wire fraud to basically build a fence around prediction markets.
Yeah.
But if you're a platform sitting inside that fence, federal enforcement isn't just a threat.
No, it's not.
It's a weapon you can use against your rivals.
Mm.
Which brings us to the internal compliance actions taken by Kalshi.
Right, Kalshi, which is the major CFTC-regulated prediction market operating domestically in the U.S.
Exactly. While Polymarket is dealing with federal indictments of its user base, Kalshi is actively going on the offensive here.
They really are. According to their corporate announcements on April 22nd and 23rd, Kalshi investigated and suspended 3 U.S. political candidates.
Wait, they suspended politicians?
Yes. The reason. The candidates were betting on their own political races using non-public campaign intel.
Oh my God. We have to look at the sheer mechanics of these bets because the sums involved highlight how automated this compliance dragnet has become.
It's so automated.
You have Matt Klein, a candidate in Minnesota, who bets $50 on his own primary race.
$50.
$50. Kalshi flags it, fines him approximately $540, and suspends his account for 5 years.
For a $50 bet. And then you have Ezequiel Enriquez in Texas.
Right.
He bets under $100. He gets hit with a fine of about $780.
And the most revealing case, I think, is Mark Moran in Virginia.
Oh, Moran is fascinating.
He places a $100 bet, but when Kalshi's compliance team flags him, he refuses to settle.
He fought it.
He fought it. And because he fought it, Kalshi slaps him with a fine of over $6,200.
Over $6,000.
Yeah. Moran later goes to the press and claims he merely wanted to get caught to prove a philosophical point about the transparency of these markets.
Sure he did.
Right, sure. But wait, let's view this from a private equity standpoint for a second.
Okay, let's look at it.
That sounds like corporate suicide.
It does, initially.
You are a platform that generates revenue from trading volume, and you are publicly alienating your users by fining them $6,000 over a $100 bet.
Yeah.
Furthermore, Kalshi's CEO, Tarek Mansour, literally stood up at the Semaphore Global Economic Summit on April 15th, announced they had run roughly 200 internal insider trading probes,
200?
and then invited the Department of Justice to prosecute insiders on his platform.
He begged them to.
How does Mansour justify literally begging the DOJ to arrest his own revenue base?
Well, because that revenue base is toxic if your ultimate goal is institutional adoption. Kalshi is currently valued at $22 billion. They are running outdoor advertising campaigns in Washington, D.C. with billboards that simply read, "We ban insider trading."
Oh, wow. I haven't seen those.
They're everywhere in D.C. Mansour recognizes that major hedge funds and institutional liquidity providers will not deploy capital on a platform where they are constantly getting picked off by political staffers and military insiders holding guaranteed outcomes.
That makes total sense. Kalshi is using compliance as a competitive moat.
Exactly. They are signaling to the CFTC and to Wall Street that they are the clean, regulated alternative to offshore platforms.
I see the logic. If you want Point72 or Belyazny to plug their trading algorithms into your API, you have to prove the poker table isn't rigged.
Precisely. You have to clean house.
But Kalshi's strategy of playing the compliant teacher's pet with the federal government is running into a massive jurisdictional buzzsaw at the state level.
Oh, it is a huge mess. This is where the structural integrity of the entire event contract market is really being tested right now.
Yeah.
In late April 2026, Wisconsin Attorney General Josh Kaul filed a massive lawsuit in Doane County against Kalshi, Polymarket, and even the brokerages facilitating the cash transfers, like Robinhood and Coinbase.
Everyone's getting sued.
Everyone.
And the mechanism of Wisconsin's argument is fascinating to me.
What's their angle?
They are arguing that these event contracts, specifically the ones based on sports outcomes, aren't commodities at all.
Oh, interesting.
Yeah, they're classifying them as illegal sports betting in disguise, which obviously violates state-level unlawful commercial gambling statutes.
Right, and that is an existential threat to Kalshi's business model.
Massive threat. Considering the court filings allege that sports contracts make up 90% of Kalshi's business.
90%.
Generating over $1 billion in annualized revenue.
Wow. Yeah, if the underlying product is reclassified from a derivative swap to a sportsbook wager, the entire federal regulatory framework collapses.
Just falls apart.
And Wisconsin is not acting alone here.
Who else is jumping in?
Arizona has reportedly filed 20 separate criminal charges treating these exact same markets as illegal gambling operations.
Criminal charges.
Yes. Nevada courts have already blocked Kalshi from offering sports-related markets to their residents.
Well, Nevada obviously protecting their own turf.
Obviously. And the New York Attorney General is actively preparing actions against prediction-style products as we speak.
Hold on. If that's the case, how does a trader actually navigate this?
It's tough.
If Kalshi is federally regulated and approved by the CFTC, but Wisconsin treats it like an offshore sportsbook, does a trader in Milwaukee who buys a contract on the Super Bowl get charged with a federal commodity violation or a state gambling misdemeanor?
Honestly, it creates a catastrophic legal paradox for the user right now.
That's terrifying.
It is. The CFTC's stance is rooted in federal preemption.
Meaning the feds overrule the states.
Exactly. The idea that the Commodity Exchange Act supersedes state gambling laws when it comes to federally approved derivative contracts.
Right.
But because the states are refusing to recognize that preemption, the CFTC is literally suing the states right back.
Wait, they're suing the states?
Yes, they are actively fighting state attorneys general from Connecticut, Arizona, and Illinois in federal court to maintain exclusive federal jurisdiction.
So it's a literal turf war between regulators.
Precisely. And the federal appellate courts are completely split on the underlying mechanics.
How so?
Well, the Third Circuit recently sided with Kalshi's interpretation, ruling that these contracts are legitimate hedging tools.
Okay, so that's a win for them.
But meanwhile, federal courts in Ohio, Maryland, and Nevada have ruled against the platform.
Oh, wow.
Yeah, stating that states possess the constitutional police power to regulate gambling within their borders, regardless of what the CFTC calls it.
It sounds like a nightmare.
The jurisdictional conflict is so deeply fractured that it is almost certainly heading to the Supreme Court for resolution.
It has to, right? There's no other way to settle it.
Yeah.
Which brings us to the ultimate question for you, the listener.
Right.
How does this reprice the information edge on your day-to-day reality on the trading floor?
That's what really matters here.
Because if you are an M&A associate with access to merger documents, an FDA reviewer looking at clinical trial data, or a hedge fund analyst modeling a congressional tax vote, the game just fundamentally changed.
It permanently changed. The perimeter of personal liability has permanently expanded.
Yep.
The days of treating an offshore prediction market as a disconnected playground are over.
Completely over.
If you touch confidential information in your professional life, event contracts are now fully in scope for federal wire fraud and commodities fraud liability.
And the institutional reaction has been swift and brutal, hasn't it?
Oh, absolutely. Major funds, including the ones we mentioned earlier, like Point72 and Balyasny, have implemented strict internal compliance bans,
Right.
prohibiting their employees from trading on these platforms entirely.
Because you cannot have your analysts risking a federal wire fraud indictment to make a quick $10,000 on an election contract.
It's just not worth the tail risk for the fund.
Not at all.
Yeah.
But look beyond the immediate compliance headache for a second. How does the removal of these insiders actually affect the mechanics of market pricing?
That's the real alpha here. It fundamentally alters the signal-to-noise ratio of the platform.
Okay, break that down.
Think about the mechanics of how these markets function before the 60-day enforcement blitz.
Right.
You routinely saw highly suspicious clusters of anonymous accounts dropping massive liquidity on binary catalysts.
Like a military strike or a surprise corporate departure.
Exactly. And they did it with zero fear of regulatory enforcement.
Because when a trader with inside knowledge treats a prediction market like a guaranteed ATM, they aren't forecasting a probability.
No, they know the answer.
Right, they are simply extracting liquidity from the people who don't know the answer yet.
And that guaranteed inside money heavily skews the implied probabilities you see on the screen.
I see.
So if a contract for a CEO's resignation is trading at 80 cents on the dollar, implying an 80% chance of happening.
You had to wonder if the market was just acting irrationally or if the CEO's executive assistant was quietly buying up the board.
Exactly. But when you introduce the very real, demonstrated threat of federal wire fraud charges, that dangerous inside money gets scared off.
So the noise drops out.
The noise drops out. And the platform ceases to be an insider's extraction tool and starts functioning like a true forecasting engine.
Because the people left are actually guessing based on public models.
Right. The implied probabilities will behave completely differently because the market is no longer pricing in the silent presence of someone who has already seen the script.
Right.
The true alpha lies in understanding how to model those odds now that the smartest, most dangerous money has been sidelined.
So if you are researching in detail how to build an edge over the next 12 months, tracking these shifts is going to be your most critical skill.
Absolutely.
The Wild West era of event contracts is officially closed.
It is, but I want to leave you with one final scenario to consider.
Okay, let's hear it.
Because the mechanics of this legal theory are about to hit a massive stress test.
Oh, I'm intrigued.
We have seen the DOJ successfully prosecute a Green Beret over military secrets.
Yes.
We have seen Kalshi suspend local political candidates over campaign data.
Right.
But what happens when the first corporate chief financial officer gets tagged for using a proxy event contract to quietly bet against their own company's disastrous unannounced earnings report?
Oh, wow. The ultimate collision of traditional MNPI and the new event contract perimeter.
Exactly. When that specific legal theory inevitably makes its way into the C-suite of the corporate world, will the smart money adapt to the CFTC's new rules, or will they simply abandon the regulated platforms and find darker, quieter, decentralized networks to trade their edge?
That is the multi-million-dollar question.
Yeah.
And you can bet we will be tracking the capital flow when it happens. Until then, keep your ear to the ground, watch how the information moves. And remember, whether it's an overheated room full of unredacted merger documents or a classified military server logging an IP address, the data room always leaves a trace.
It really does.
Thanks for joining us for another session of the Insider Signal podcast. We'll catch you next time.